Present value factors, time value money. Oh, the ever important and oh so ever confusing topic here. Just to recap, if you are familiar, and to teach you if you are not. Okay, so gosh, there's just so much to say about this. Essentially, it's really just that money is worth more today than it is tomorrow. Now, you might say, why did we not use this? For example, in FAR, we only use it really for bonds and leases. Well, I mean, in theory, yes, you can present value factor everything. I mean, I could say that my paycheck in 2 weeks is present value factored by a certain decimal because yes, it's worth less to me because I'm only getting it 2 weeks from now. I'm not getting it today. But that would just be ridiculous. That would just be way too much work. So we present value factor numbers that are more susceptible to this, such as again bonds, leases, and what we'll see here in VEC. Let's just take a step back as well. For all of you, maybe familiar or not familiar, generally you get these big present value factor charts. And are you ever going to have to calculate these numbers? And my answer to you is no. What those are generated by are actuaries, and anyone who's not familiar with an actuary, those are super smart and presumably overworked individuals who are really good at math, and they essentially predict. They work for insurance companies a lot, and they predict the likelihood of someone get a little morbid, making it to a certain age. Really trying to take into account every factor, because why is my money worth more today than it is tomorrow? Well, because I could use that cash today to pay down debt, which reduces my interest expense. I could use that money to invest today, and if I can invest it today, presumably, the earlier you invest, the more money you make. I can pay my employees. I can just utilize it more. There's just so much I can do with money today as compared to in 2 weeks. Also, inflation takes a role, right? Inflation is always ever increasing, so it's better to have your dollars today so you can do something with it. Now, what factors are we going to use? Well, again, what's the point of this? I don't know. What is the point of this? Let's just skip this. We're not going to skip it. We're going to run through it, make sure you're familiar. So if I have a lump sum payment, right? Let's say I have to pay a lump sum of $10,000 in 3 years. Well, what do I do? Well, I mean, normally I could just, use that $10,000, but the question says you have to factor it. What do we do? Well, we are going to use a lump sum payment structure here. We've got the present value of $1. So this big old chart will just have factors for present value of $1. So again, lump sums are, you use the present value of $1. Just straight up memorize that, please. However, if this $10,000 is an equal annual payment made at the end of every year, we're going to use the present value of an ordinary annuity. So again, if let's say it's in 3 years, I'm making a lump sum payment of $10,000 to someone. I'm going to use the present value factor. It's going to be a decimal that's less than 1. So let's say it's 0.75. I'll do $10,000 times 0.75. Now, let's say I have to pay the bank $10,000 every year at the end of the year. And why is end or beginning of the year important? That's quite critical because a whole year has passed, right? And that's extra time to account for the time value of money, inflation, and interest, and everything all there. So we are going to use the present value of an ordinary annuity if I am paying this every year. And this will generally be greater than 1. I mean, it's going to be that case. So let's say it's in 3 years. It'll usually be something like, let's say, 2.75. And you don't have to memorize this. This is just from my experience going through this. And why is this? Well, because $10,000 for 3 years. Yes, that would be $30,000. Now, because the actuaries and the super smart people who generated this report for you, they determined that, okay, it's going to lose 0.25 of its value, right? I mean, you can put it in percentages, but I'm just going to leave it in our present value factors. So it's worth a little bit less than 3 because paying it in the future. Now, as the payee, right? Like the payor, the individual who's paying the bank, it's better for me to pay in the future because I want my cash now. So in reality, what this is saying is, my money, my $10,000 that I have to pay. So in reality, yes, I'm paying $30,000, but in reality, with the present value factors, I'm only really paying $27,500 of value. That's just me multiplying these two together. Do you see there? That's why debt's powerful, is because I'm, again, only really paying value of $27,500 because I decided to finance this over a few years. Just take it all in. There's a lot here, and I'm going to just demolish every possible question you have on this while we're on this page. So present value of $1, what are other instances you could use this for? Well, if I have a machine that is going to get a salvage value, a residual value, same thing, synonyms right here, residual and salvage value. If I'm getting a, let's say, $10,000, I can sell my machine for $10,000 in scrap metal in 10 years, then I'm going to use a present value factor, right? That's what I'm going to use, a present value of $1. That's a lump sum payment, a one-time lump sum payment in the future. So I'll use the present value of $1. Any type of annuity question, right? You get annuity payments. You could be receiving money, paying money, right? This is going to be, anytime there's equal annual payments, and it has to be equal, right? Equal payments. That's how these are calculated. So it has to be $10,000 or $20,000. What if it's not equal annual payments? Well, then you're going to have to use a bunch of present value of $1. So you'll use the present value of $1 for 1 year and then for 2 years, and it'll take longer, right? It's that you can always use the present value of $1. It's just essentially this makes it easier to work with because you don't have to multiply it every single year for every single time. Now, annuity due, whenever you're reading a question, you approach it. First, identify which are you using and cross out what you're not using. Again, this is the end of the year, and the only difference between these two is annuity due is when the payment is made at the beginning of the year. This is much more common. However, this does appear. This is when the equal annual payment is made at the beginning of the year, so it's less common than an ordinary annuity. One less year has passed as it relates to time value of money, so one less year has passed, and we are not accounting for the interest and everything I mentioned, all that good stuff. We'll also have a percentage that you have to match here. So it'll be present value of $1 for 3 years at 7%. And what is that percent? Well, that's, again, calculated by the actuaries. And that could be the cost or the inflation premium. That's determined by it'll be given to you in the question. Now, we'll see that and use practical examples of determining what percentage to use. A lot to see here. Lots of great points to make. We'll see this. You see this in FAR if you haven't already, so get good at it. It's great to see something that you'll see again. That way you don't have to study as hard. No, but you're going to study just as hard. You're going to do well on all these exams, right? So we'll use this for a lot in this exam here in particular, right? For the net present value, if I buy a machine and it makes me $1 million every year, I have to present value factor those payments, the $1 million I make every year, and each one as the years go on is worth less and less. Perfect. Let's move on. The tax shield formula, to just kind of give you a nice prelude, right? The present value factors and tax shield formula, these are all just introductions because they'll all come together when we start answering some hefty questions. Well, what's your tax shield? It's the deduction times the tax rate. That's how much you are shielding from taxes. So, for example, what's the adjusted net income here? We have after-tax net income of $800,000 during the current year. However, we realized an error that the company did not include depreciation expense in its after-tax net income amount. So instead of going through and recalculating everything, we can just simply determine what's our adjusted net income, our tax shield. We had total depreciation expense that we didn't include, but now we have to, of $200,000. Current tax rate is 30%. So 30% times the deduction. 30% of this gets reduced from our taxable amount, and now our adjusted net income is going to be $800,000 minus $60,000, right? This is our adjusted net income for tax purposes. You want your book income to be high, you want your tax income to be low. This is going to be taxed lower, right? So right here is what we're dealing with. This is our tax shield formula. We'll see this in plenty of examples. All right, we've talked about net present value. We're going to talk about it even more because it is quite prevalent on the exam. Do not fret, do not worry. I am your guide through this wonderful topic. So we talked about it. It's the present value net of outflows of a project. Project that could be opening a new factory, opening a new restaurant. If the net present value is positive, accept the project. And that's not revolutionary. That's not a crazy idea. Well, your inflows are greater than your outflows, then yeah, sure, accept the project. That sounds pretty good to me. Net present value is a direct measure of how well a project will meet the goal of increasing shareholder wealth. That's why we do what we do, right? We want to bust our butts to make the shareholders wealthy, right? I'm sure all of you working at companies or firms, you just loving the idea of making someone else richer. That is what we do. The humble life of an accountant. All right, so net present value, again, is discounted inflows minus outflows. Now, I mean, sure, you'll discount the outflows as well if need be, but generally speaking, these questions are going to say, oh, you paid $1 million right now. And since no time has passed, there's no factoring to be done to the outflows. If time has passed, generally, you're not getting inflows on day one. Anyone who tells me there's a way to make a massive return on day one, well, that'd be great if you could share that with me. I'd love a new opportunity. So when the net present value is greater than zero, this, again, should be inherently understood, but these are from multiple choice questions. These are, things that we might need to answer as possible explanations and answers. When the net present value is greater than zero, the project is expected to add value to the firm. Also, it will increase the wealth of the owners. Yeah, nothing crazy. Just make sure you understand this. I mean, I'd say memorize it, but if you understand it, it should kind of click and make sense. Well, the moment you've all been waiting for quite patiently, we're finally here. We're going to do an example of net present value. As promised, we've got our net present value chart given to you in the question. And now it's up to us to solve what is the net present value of the printer. Should the company buy it? Generally, it's going to be a physical asset that you're going to buy, and you're going to try to make money off of it. And hopefully, that's the goal. That's what we do in business. And, well, what's the net present value of it? And should we buy it? Should we buy it? That's probably going to depend on the net present value. Let's see. We're faced with a purchasing decision. The team at Multimedia Inc. can purchase an industrial printer right now for $200,000. This is important because we know that this is not going to be factored, right? It's immediately just right now, outflows of 200. The machine has a useful life of 3 years and residual value of 15,000 at the end of its useful life. So we can sell it for scrap for 15,000 at the end of its life. Thanks to this innovative printer, the team at Multimedia Inc. estimates annual savings of $110,000 in operating expenses. That's nice to see as well. The company uses a 35% income tax rate for its calculations. What's the present value, the net present value? Again, this is just inflows minus outflows. And let's see what those look like, because that'll influence, again, whether or not we should buy it. Well, we know straight up our outflows are $200,000, right? Great. And this is going to continue on to another page, so no worries there. It doesn't end here. The fun never stops. All right, so we need to take all these other factors into account. This is a decision, and this decision affects annual savings. It affects, now that we're going to get a residual value, right? All of this is super important. Now, all of this is after tax, as you can see. Yes, we have 110 of annual savings. However, we need to take that into account after tax. We have $15,000. We need to take that into account after tax. And we need to calculate the annual depreciation tax shield, right? So you spend money, that's deductible. And what's our depreciation tax shield? We are going to take a third of this because annual depreciation, right? 3 years. Depreciate the machine over 3 years. So this is our annual depreciation. What's our annual tax shield from the depreciation? So all three of these steps are the same. It's just what are our expenses or items that we need to get the after-tax amount for. These two are deductions from taxes, and this is a future inflow. So it's not an inflow from operations, right? It's an inflow just from scrapping the machine, but it's still an inflow nonetheless. So 3 numbers we're going to carry over are the annual tax shield, the after-tax annual savings, and the future one-time inflow of $9,750. We're going to need these present values as well. let's keep moving on. Step 4 is we're going to calculate the net present value. As mentioned, it is a simple formula of outflows compared to inflows, inflows to outflows. And just to, not to skip ahead too much, but here's all of our inflows minus our outflows. So just so you see the bigger picture as we're going through the small steps. And we see it's a positive net present value, which is very much going to mean that, yes, we are going to accept this project. Not to spoil it. Not that I'm sure you care more about TV show spoilers than spoilers in the question. Just want to give you a good picture. Just another thing to keep in mind, salvage value equals residual value equals resale value. Maybe you don't scrap it, you resell it at the end. That's all the same. It's treated the same. And with that being said, let's actually dive into it now. Okay, well, we have our numbers that we're counting across. We have 3 years. I mean, this is year 0, and we bring to attention it's year 0 because whatever happens in year 0 does not get factored using our present value factors. You see here, we have a present value factor of 1 because that's the equal value of it. Nothing has changed. So what happened in year 0? What happened in year 1, year 2, year 3? Now in year 1, we have depreciation tax shield and annual savings just from information provided. That gives us a total undiscounted, right? The process of applying the present value factors is called discounting. So the undiscounted after-tax cash flow is $94,833. And let's go back to our present value factors. Well, we look at these and we are going to use the factors in that year. So for example, year 1, we use 0.862. And the reason why we're using this instead of the ordinary annuity, I know these are, equal annual amounts, but as I mentioned, well, you can always trust the lump sum present value of $1 amounts, and these are not equal annual payments. You see here, we've got a different amount. So better safe than sorry. In this case, I would use the present value of $1. That being said, you could use the 2-year one for these 2 years. This is just the way I'm choosing to do it today. You will see other examples of me doing it using the ordinary annuity, but I think it's important to bring it to your attention how you could go about these questions, right? Nice practical advice, teaching you and showing you how to do these questions. And now we're just factoring these inflows. So in this case, it's not like this machine is giving us an inflow because we're selling goods better. It's what is the inflow in this case? Well, the inflow is saving us money, right? And that's a way to think about it. I mean, yes, you could have a question where the machine is actually physically making us money. It's the same thing, same treatment in both cases. It's totally fine either way. That's just how these questions work. So we factor for 1 year using our lump sum factor. We factor for year 2. So we're going to keep using these factors of the present value of $1. You see how dynamic these are, how we can use them. Nothing too crazy. And we get our new amounts, right? So this amount is worth a little bit less each year because time value of money, time marches on and takes the value of our money away. And lastly, we are going to take, now these are all inflows here, all inflows, and the $9,750, the salvage value comes back into play. We're going to get that aggregate amount of undiscounted, all of our inflows, so anything that can be considered an inflow, such as deducting taxes and preventing expenses from increasing. We use our present value factor, get our amount. So we have 3 years worth of inflows, and here they are. Add them all together and then subtract the $200,000 gives us a total net present value of $19,245. As mentioned, this is a positive amount, and sure, we'll accept it. Now, in reality, I mean, if you have a net present value of $3, I mean, is it worth it for you to do this project? Maybe not, but that's not really what this test is going to get into. If it is positive by any means, then sure, your answer is yes, you will accept it.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of cpa.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.